What's good, y'all? It's your boy Marcus, and you're now tuning in into the Be Do Have Investing Mindset podcast. In today's episode, we're going to do a continuation of part 2 of how to analyze a real estate deal. Now, if you haven't seen my first video, definitely subscribe to my YouTube channel, Ascension Team 1, and look for that video that says how to analyze a real estate deal. Now, for part 2, we're going to do a continuation and talk about cap rate, value, cash on cash return, and debt coverage ratio. On part 1 of the video, we already talked about the purchase price, rental income, expenses, net operating income, and debt services. Now, these terms right here are as equally as important as the first video. So analyzer helps me drastically. Now, I don't know formulas off the top of my head, so this is why this analyzer is really important, because I plug the numbers in and it does it for me. All right, so let's talk about the capitalization rate, aka cap rate. So for beginners, I have a basic criteria. For cap rate, anything under 8% is not as exciting for me to do my due diligence towards the property. So my minimum cap rate that I have for every property just to start off is 8%. Anything less than 8% most likely may be a bad deal, but that doesn't tell the full story. Cap rate gives you a good indicator, and it's a great measurement to see what you're paying for the property based on the purchase price. So let me keep it real simple. The purchase price of this property is $100,000, right? Now the NOI, the net operating income, is $19,680. When you divide those two, you get 19.68%. Now remember what I said earlier. My minimum cap rate limit is 8%. Anything below that may not be a great deal, but that doesn't mean that you should stop doing your due diligence. But for this property example, it's 19%. So that means that it's generating a lot of income, and this property is a good deal. So once I see 19.68%, I get extremely excited, and I'm like looking at the numbers, it's looking good. So I move on to the next. So the next one is value. Now, value is very interesting because a lot of sellers think their property is worth more than what it should be selling for, right? So as an investor, you have to look at the income and the asking price and the NOI. And based on those numbers, then you can see if it justifies the value of the property. Now, some sellers who sell a property might be $10,000 over the value or $20,000 over the value, and that might be justifiable. But as an investor, you have to look at the income and the market cap rate. And how you determine the market cap rate is you have to look at comparables, aka comp. So you have to look within a 1 to 2 mile radius to see what other properties are selling for and see how much income that property is generating. And you could get that information from brokers, agents, other sellers. And if you see a trend within the 1 to 2 mile radius and the numbers are not too far off, then it might justify why the seller is selling that property for that particular price. But based on this analyzer, based on these numbers, this property's value makes sense. So as an investor, you cannot get caught up with the selling price. You have to focus on the income. Now, to keep it much more simple, if you need a formula just to justify to see if the seller is making sense of selling that property for that particular price, what you're going to do is you're going to get the NOI, divide the market cap rate, which is the comparables within that 1 to 2 mile radius, and based on that number, you'll get the value of that property. So as an investor, you can justify your reasons and negotiate a better deal once you plug in those numbers, which is the NOI divided market cap rate. Based on those numbers, you can have more leverage in negotiating a better deal for your property. So don't get caught up in the seller's asking price. It's just a starting point, and based on the analyzer and that formula I just gave you. Now the next is very simple. This is cash on cash return. Basically is how much money you're making per year based on the income that your property is generating. So the next is cash on cash return, and this is extremely simple. Basically is how much return on investment you're making back on it. So for this example, your monthly cash flow is a little over $1,000 a month. If you times that by 12, you're generating over $12,000 a month. So you get your annual cash flow, you divide how much you put down on the property. So for this example, 1,052 divided by 20,000. You take that annual cash flow amount, the total amount of months that you make per month, and you divide that by the down payment that you put up for the property. Once you divide that, you get about 60 to 63%. So you're making 60 to 63% on your money year after year, which is amazing. That's a great measurement and a good indicator to let you know that this is a great deal. So keep it simple. You basically invested $20,000 and the property is giving you back over $12,000 a year. So after year 2, you already made your money back, and everything after that is infinite returns. Now, the last one was called debt coverage ratio. Now, this is not for you, but this is for the lender, but it's extremely important for you to know. Debt coverage ratio, aka DSCR for short, it tells you whether the property can comfortably pay off the mortgage. So for this example, 2.79, that means that the property is making almost 3 times the money that it needs to pay the mortgage. So basically, your property is not struggling to pay the mortgage because it's generating enough income to generate cash flow and pay off the mortgage comfortably. Because if you really think about it, let's say, for example, your mortgage was $100. And if the property is only making $100, then your property is risky. But if a lender or a bank sees that your property is making twice as much more money to comfortably pay the mortgage and then have money left over, that's what banks are looking for. Because at the end of the day, banks want to know, if we lend you the money, we want to know that you can pay the property back. The higher the debt coverage ratio, the more comfortable the lender feels lending you money. So just to give you an indicator for the debt coverage ratio, so anything over 2 is extremely excellent for a bank or a lender to see. Anything that's a 1 or below, the banks are definitely not going to lend you the money, and that's a great sign to scrape this deal and go to another deal. But for this example, based on these numbers, anything that has a 2 or above is extremely exceptional, and it's a great deal. So today, we covered the cap rate, the value, the cash on cash return, and the debt coverage ratio. Now, don't get caught up in the formulas. The goal is not to be a mathematician. The goal is not to be perfect. This is why the analyzer is here. So in my book, If a Fifth Grader Could Do It, You Can Too, Real Estate Investing Made Simple, in chapter 10, How to Analyze a Deal, you click the link and it literally gives you this exact analyzer. So you can plug in the numbers and it does everything else for you. My job is to keep things simple. And me personally, I don't know all the formulas by heart as well. But just to get things started, just to get things rolling, use this analyzer like your life depends on it. Because I use it for every single deal. So you'll know if it's a good deal, a bad deal. You'll know about the cap rate, the value, the cash on cash return. And everything else I talked about is extremely valuable. And this analyzer is actually in my book. In chapter 10, How to Analyze a Deal. If you purchase my book, If a Fifth Grader Can Do It, You Can Too, Real Estate Investing Made Simple, you go to chapter 10, click the link, and you will automatically get this analyzer. Use this analyzer for every deal you come across to buy back your time. You won't waste your time, other people's time, and it plugs all the numbers in there for you. If sellers or brokers are trying to sell a property that's way overvalued, I use this as a guide to help me decide if it's a good deal or a bad deal. If you're a beginner or not, you'll look more like a professional knowing the numbers instead of guessing. If you like this video, show me some love. Subscribe to my YouTube channel, Ascension Team 1. Subscribe to my TikTok, the Ascension Team. It's your boy Marcus, and I'm out.